Datadog is one growth stock down 67% that I think you might regret not buying on the dip here. Why do I think that's the case? Well, that's what I'm going to talk about in this video, so let's begin. So Datadog has been one of the fastest growing stocks in the market. Now that growth rate has been decelerating. In its most recent quarter, it grew at 43.9%, and management is forecasting a continued slowdown in revenue growth as its clients are looking to save money. And one of the areas where they can do that is in cloud solutions like Datadog in its observability solutions. Still, Datadog and industry forecasters expect its market to grow from around 40 billion in 2022 all the way up to close to 70 billion in 2026. So the market for its services, observability solutions, are going to grow over the next several years, while this current year is likely to be the slowest rate of growth out of the next several years. And that's understandable. Enterprises fear that the economy, worldwide economies, will enter slower growth. Some major economies like the US might experience a recession in 2023. Well, at least the probability of the recession is increasing as more indicators come in, and the Federal Reserve continues raising interest rates to fight off inflation. So it's understandable that businesses are taking a cautious approach and pulling back a little bit on their spending in these types of solutions. But what's important is that they are not canceling these types of solutions, right? They're just slowing the spending, they're delaying it, they're pushing it out maybe 3 months, maybe 6 months, maybe 9 months, but they're not canceling it. But because these are increasingly becoming necessary to transition towards cloud solutions and the types of services that Datadog offers. So this is one of the reasons why I think this is an opportunity, because the industry overall is going to grow longer term, but in the near term it will experience a slowing of that growth, a pausing, a more cautious approach, which I see as an opportunity. And here is something that I find to be very attractive in growth stocks like Datadog is to see increasing cash flow from operations to sales as revenue grows. So this is CFO to sales over the trailing 12 months. And if we look back from January 2020 till about January 2023, you see Datadog showing nice increases in terms of cash flow from operations to sales. What that shows me is the company is getting more efficient as revenue is scaling higher. So you think about things like rent, like employee wages, like depreciation and amortization. All these costs are sometimes they can remain fixed while revenue grows, and that creates leverage where your costs stay relatively flat and your revenue grows, and that allows your margins to expand, which is what I like to see from companies that are growing. I don't like to see companies growing revenue and their margins and cash flows going in the opposite direction. What that shows me is they're not getting better at what they're doing, they're just spending more money to achieve growth, which I don't like to see. I don't think that's attractive as an investment. And you can see the similar characteristic working in Datadog's operating profit margin over the trailing 12 months. You see it went from negative, let's say 10% up to negative 3.5% in its most recent update in the trailing 12 months. Now you see the figure is negative, right? Negative 3.5%. But if you've been watching my videos, you know that I'm okay with companies with negative profit margins so long as I see improvement in the trend, so long as I see them making progress towards profitability. What I don't like to see is negative profit margins going in the opposite direction as revenue is growing. What that shows me is the company's just spending money so that they can achieve sales, right? There, of course, you can increase your sales if you increase your spending on sales and marketing, if you increase promotions. Of course, that can boost sales, but that's not growing effectively or efficiently, and that's not something that investors should be attracted to. So what Datadog is demonstrating to me is that they are growing effectively and efficiently, which is what I like to see and which is what I check for when I'm looking at growth stocks like Datadog. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And finally, the last reason that I will show you as why I think you might regret not buying this growth stock on the dip is because you've scarcely had an opportunity to buy Datadog at this valuation. So Datadog is trading at a forward price to earnings ratio of 46, which is the lowest it has traded for over the last 15 months. You look back at this chart going back 15 months, and you haven't had an opportunity to buy Datadog at a lower price. Now, relatively speaking, Datadog is selling inexpensively. However, if you just look at the price to earnings ratio forward PE of 46 and compare it to other stocks in the market, it's not cheap. It's not cheap. The average price in the S&P 500 forward PE is between 16 and 19. So Datadog is more than twice the price of an average stock of the S&P 500, but that premium valuation, in my opinion, is justified because Datadog is growing much faster than the average stock. It's increasing profits much faster. It's increasing profit margins and cash flow from operations much faster than the average stock. So it deserves a premium valuation. All right, so that's all I've got for this video on why I think that Datadog is one growth stock you might regret not buying on the dip. Thank you so much for watching. I hope you'll tune in again next time.